Hello, everyone. I first of all need to apologize for the time I've taken away, but this is Stock Common Sense. Um, Without further ado, let's go ahead and get started. If you guys go ahead and see my screen, what I'm currently showing is the S&P 500. Now, for the past 3 weeks that we've been gone, you can see these red candles have all been downturns, all been downturns. We had a strong week in S&P 500 this week right over here, where we ended up actually 6.68%, who ended the week at 39.11 after closing last week at or getting to as low as 36.30 or 36.36. A lot of things have happened in between then to drop the market like this, whether it's from rising interest rates, whether it's from higher inflation. And we'll talk about that high inflation. We hit another mark of 8% when we thought we were getting things under control. And when that didn't happen, you saw everything come crashing down. Now, what does give me some hope that hopefully we can get everything under is that this bar right over here represents the 200-week, make sure it's clear, 200-week moving average. And we pinged this and shot immediately, or this was used as support, right? This is able to be used as support. We ended up closing the week at 36.74 and rising up 6.7%, getting up to as high as 39.11. Now, this was good news. If you are able to see this red bar over here, I wanted to show this to you. I wanted to show this to you guys. This red bar represents the 20% decline from 48.18. And if you look, we passed this last week to where the stock market or the S&P 500 was officially in a bear market. Officially in bear market. What that means is that the market was down 20%. We closed below it, so we are officially in a bear market. Now, looking at this, I am hoping that if the Federal Reserve can get things under control, if inflation can come down, if we can get enough economic factors to show that a slowdown is in progress, that this will help us be able to recover, right? Because we had such a rapid growth within the economy, unemployment is a record low, a lot of money floating around. This is what caused the market to get extremely overheated, causing the Federal Reserve to raise interest rates. And by raising interest rates, it basically means the cost to borrow money is now more expensive, right? So if you try to go get an auto loan, a home loan, um, a personal loan, credit card loans, or credit cards all in general, the cost to be able to borrow is significantly higher than what it was beforehand. And the rates will only keep getting higher. I believe we're currently at 1.5 or 1.25 currently right now. We ended up having a 0.75 increase. So I wanted to go ahead and show you guys this chart. I What we want to see within this market to at least give us some hope is that we see lower highs and lower lows. Lower highs and lower lows. No, I'm sorry. We want to see higher highs and lower lows. Now, if you look, anytime that we hit a high, it was rejected. So if you look, came down. If you look at all our lows, low, low, a low, and a low. So we're basically taking stairs downwards. That's what we don't want to see. What we want to see, if I were to scoot this back, is we want to see stairs going upwards, right? So if this was the low back in 2020, you can see we try to hit a low and we went higher, low, higher, low, higher. See how the curve is basically going up like stairs? That's what we want to see. But instead, we're going the opposite direction. So what we want to see is if we can withstand this, if we were to have another low, that low stay higher than this current low, and then slowly build our way back up. I forget the analysts, but we still have analysts still thinking that we'll end the year at 48.18, which basically leave us flat. So, but remember, this is a long-term game. So any lows that you see, I'm letting all my clients and those around me go ahead and buy. Or I'm telling them, hey, go ahead and buy. Just go ahead and buy. Go ahead and buy. Um, because we know long term always wins out. It always wins out. So that's the S&P 500. I'm gonna go ahead and show you guys the Russell 2000. And if you were to look at this, this is the one that while I love the SP 500, the Russell 2000 is the one that let me know early on last year that we kind of hit our peak within the market. So if you were to look, we're still making those stair steps lower and lower and lower. We hit our low last week, but this was a great support. This was an amazing support that we drove up earlier. Last week we ended up 7% for the week, which was pretty major, pretty big. We're currently at 1765, still down from its high of 2458. But the reason why I love this because this has the smaller mid cap companies, and typically whenever the market falls apart, this starts first. And when the market starts to rebound, it starts with this. It starts with this. So I want to see if we can continue to push up and withstand the downward pressure and see where that overall takes us. I'm gonna see where this overall takes us. Um, so next week, I'm hoping to see us close above this resistance line. I mean, we did close above it, but if we can stay above this resistance line, that will give me some positive uh, that will give me some positive reinforcements that the market has either bottomed out or withstanding any more bad news. All the bad news is priced in, whether it's an incoming recession, whether it's higher inflation news, which we should figure out sometime next month. All those things will be coming in. So I want to be able to watch this and see what happens from there. Moving on to things that happened during the week. Let me go ahead and pull this up for y'all. I'll move this over here. So, like I spoke about earlier, the Federal Reserve was able to raise the interest rate by 0.75. Um, Coming from the Wall Street Journal, officials agreed to a 0.75 percentage point raise at their two-day policy meeting that concluded Wednesday. Now, this happened about 2 weeks ago. Yeah, this happened about 2 or 3 weeks ago, and this was a counter response to inflate with the highest inflation reading, with the 8.3. What ended up happening is we had an inflation reading of 8.3, and if you remember, Jerome Powell said a 0.75 percentage point was not on the table last month. But whenever we received that higher CPI rating, this forced their hand to say, okay, no, we want to make sure that we're taking this serious. We want the markets to know we're taking this serious. We have to be able to raise our points as we have to raise our interest rates at a reasonable point to show that we are battling this. Um, and when this occurred, the market was ecstatic and it jumped, I believe, by 1 or 2% the day after the day he raised it. But then the next day shot back down because remember the higher interest rates means lower growth for not only the market but also the economy. So growth stocks took a big hit. So if you were to pull up the Nasdaq, I'll go ahead and show you guys this. If you were to pull up the Nasdaq, you can see that on this week it was a big decline. I believe for that week we opened up we got to as high as 12,810. It shot down to 11,842. So it was a tough day in the market for that to happen. So I want to go ahead and show you guys that. So here's a chart that also explains that where we were raised by 0.75. If you were to look here at this chart, every gray bar shows a recession that occurred. Shows shows a recession. During times of recession, we lower our interest rates to be able to let companies increase their growth and be able to borrow funds at whatever rate that they need to occur. The last one that occurred was back in March 2020. You can see we dropped our rates basically from 1.75 all the way down to 0.25, down to 0.25. But with that rate increase, just at 0.75 was the largest rate increase since 1994. It's 1994. So that was a major news within the market. So I wanted to go ahead and show you guys that. Um, so that was one thing. Next thing that occurred within the market is that we still have gas being at all-time highs. So, or not all-time highs, it's actually decreased since the last time we spoke. So if you look, we hit our high back in of March of this year when we hit $130. Now prices of a barrel, I believe last week hit an average price of five, or a few weeks ago of $5 per barrel. Since then we have been sliding down, which you should be able to see within the markets. We closed this week at 107.06. So you can see that there has been an effect within the market, getting to as high as or opening up and getting to as high as 123 and then sliding down. So these are things that we do like to see. We want to see gas prices come down, because as you know, it is affecting not only your pockets, my pockets, the airlines' pockets, anyone that deals with engines that need gas. It is affecting their pockets in such an amazing, crazy way. Um, but overall, we're doing whatever we can, or the government's trying to do whatever we can, to try to get this down. I believe, if I read correctly, that even not Jerome Powell, but Biden's even looking at reducing some of the gas taxes that are federal gas taxes to try to help out with our pockets, as well as sending out some gas rebate cards. So that is something that is on the table. So just be on the lookout for that. And speaking about travel, that has not hurt, well, it's hurt our pockets, but it has not stopped us from traveling. Um, Using this indicator, not this indicator, but using this article here, Americans set to road trip a record for July 4th despite sky high gas prices. With the corona and everything happening, everyone being booked into their houses, even with these high gas prices, it's not going to keep us chilling within the house. We're still planning on getting out, spending money, and doing whatever we can. The national average per gallon, what month it was? This was published on the 20th. Stood at around $4.98, just pennies up the $5 we spoke about earlier. So this is something that we will be watching. If we were to look at some sectors that are in this market, if we look at Jets, that is the U.S. airlines, you can see that this ETF that shows all the top American uh, shows the top American airlines. Their ETF is at $17.42, with its high being, or the most recent high being at $25. Um, this has been sliding down, but this is a ETF that is based off of U.S. travel. If we were to look at, I believe, what is this? There we go, Bookings Holdings. This is a company that also specializes in vacations and travel. Their stock price is down from the year. Uh, they opened the year at 23.89. They're currently down 19.31. Another one that we all love, Airbnb. They opened the year at 165. They're currently down to $92. Currently down to $92. So they've also taken a hit. But a lot of these places are reporting high revenues due to some of the fact that people are still getting out on the road, they're still traveling, they're still going on vacation, doing things of that sort. So just something to watch. Now, one thing that does affect many individuals, especially ones that, friends of mine who are trying to become first-time home buyers, mortgage rate mortgage rates are climbing. And if you know, then you know. Mortgage rate hit 5.78, the biggest weekly jump since 1987. Now, this came out back in June 2006, or just came out in June 16th. Mortgage rates surged more than 0.5% this week amid rising inflation and interest rate hikes by the Federal Reserve, according to Freddie Mac. The jump is the largest one-week increase since 1987. Now, here is why this is big. If you were to look at monthly payments, and I'm gonna pull up a calculator so you can go ahead and see it. I will go to realtor.com, and I currently live in Texas. I want to show you a calculator to show you how much prices of homes are just within the area, and we'll use just a random Fort Worth zip code. So we'll wait as this pulls up. Now, Los Angeles is set, but we're gonna do Fort Worth. And let's go ahead and do a home price, let's say 275. Now, if you were to look, interest rates, this is an average rate of basically 5.3. If you were to put down 3.5%, which is a FHA loan, a down payment for a $275,000 house would be $9,625. With a 30-year mortgage, you'll be paying $2,419. Okay. Now you see your principal. Here in Texas, we pay property taxes. You have your home insurance, HOA fees. We're putting that zero just for right now, and your mortgage insurance. To be able to close down, you have your 3.5% for the FHA loan, and your 4% closing costs. So do at close, you're paying $20,625 basically to close on your home. With mortgage rates at basically 5.3 here in Texas, you can see how high this amount is. With many first-time home buyers still having to pay off student loans, many have children, so you have to factor in daycare, auto loans, and if they don't have a high-paying job, you're stuck renting for as long as you can, right? I believe I read an article that said the average rates or the average rents across the nation for the first time ever hit $2,000. So to be able to own just a basic home that's around 275, you're having to pay this amount. A year ago, when rates were at 2.3 at all-time lows, you can see this drops the mortgage rates down to 1968. So basically close to a $500 difference. $500 difference. That is crazy. Flat out craziness. And it's all because they're trying to get the mortgage or trying to get interest rate or not interest rates. We're trying to calm down the rates on or the skyrocket of prices of homes. If you look, it is hard to get you a home that's under 200,000, especially in the DFW area. Now I know that might be still in other areas, but along those same lines, it's becoming tougher for first-time home buyers to be able to get into the market to buy their first homes, just simply due to all the things that are going against them with with rising rates, with rising prices, with such a short supply of homes and people coming in overbidding for homes just to get in. It has become the wild, wild west just to get into a home. So I wanted to go ahead and show you guys this because I believe it's been higher since then. So if I were to pull up this chart, let me see if I can do this. One second. I don't know what I'm doing. data, and then we'll go to I'll put 30-year mortgage or not. Sorry, guys. I should have had this prepared and ready for you guys, but here we go. Mortgage rates, 30-year. You can see we'll go from here over. You can see as of today, we are currently at 5.78. So still steadily climbing. You can see such an increase go from, let me see, we got to as low as 271 and we're currently at 578. So you can see how over time we've been sliding down and sliding down. And it's not, while they're still historically low, because if you were to look at this chart, which is still mind-boggling to me, people used to pay back in 1982, they used to pay 18% just to get a home. Now, the prices of homes were lower, of course, but still, that is wild to even hear. But you can see we've been sliding down year after year after year after year. Back in 2000, during the crash. Was that during the crash? No, I'm sorry. Yeah, before the crash, 2000, we were there. The average rate was around 8%. Uh, Housing crash again, or no, 2000 was the dot com. Then then the crash, the housing crash, mortgage around 6%. So we're basically back within those back within those times. So just something to watch out for. Just something for you guys to be able to see. Lucky for us, we were able to refinance from our home into a 15-year into a 15-year mortgage, and we're only paying about 2.5%, or yeah, 2.5%. So just some I wanted to go ahead and show you guys. Um, so just be aware, this is what interest rates are actually, how interest rates are actually affecting the market. Going to the stock of the week, let me go ahead and show you guys this. We will be talking about Nike, my favorite, one of my favorite companies. And I currently, just to give out a disclaimer, I do own shares of this company, just to be transparent. So if you to look, let's talk about Nike. They closed the week at $112.91, up from the previous week of $107.34. Um, Good thing about Nike, or a big news coming for Nike, is that they have their earnings tomorrow after the market close. Um, so this will be something that I will definitely be tuned in to see how they're handling COVID shutdowns in China, how their profit margins doing, um, how do they plan on going more direct to consumer. This is something that I'm definitely be watching out for it for this current week. Now, Nike is engaged in designing, marketing, and distributing of athletic footwear, apparel, equipment, and accessories for sports and fitness activities. The company's operating segments include North America, Europe, the Middle East, Africa, Greater China, and Asian Pacific, as well as Latin America. The focus is Nike brand products offering on categories such as running, Nike basketball, the Jordan brand, football, training, and sportswear. It also markets designed for kids as well as other athletic and recreational uses such as American football, baseball, cricket, golf, lacrosse, skateboarding, tennis, volleyball, walking, wrestling, and other outdoor activities. It sells a line of performance equipment and accessories under the Nike brand, including bags, socks, sports balls, eyewear, timepieces, digital devices, bats, gloves, protective equipment, and other equipment designed for sports activities. Their business activities, or let me go ahead and show you guys this. Their business activities is comprised of 68% footwear, then 24% Nike brand apparel, and then 8% other. Their year to date, they're currently down 32.3%. For the year, they opened up at 167. For the year, or for 1 year time, they're down 15%. For 2 years time, they're up 11.4%. And 5 years time, they're up 113%. Once again, they are down 37% from their high of 179. But this is a company that I strongly, strongly, strongly believe in. Their fiscal year 22 guidance is expected to be around mid-single digits of revenue growth. Reason being is they had record high growth from the rebounding from the pandemic as they started going more direct to consumer. They're also creating more stores and kind of cutting out the middleman. So if you remember a few episodes ago, we talked about how Nike's getting out, or they're not getting out fully, but selling less business to business building, or not buildings, but business to business. So for example, they have less inventory in Foot Locker and Champs and other sporting goods, and going directly to the consumer. So they're building more of their stores. They're selling more online and going straight to consumer. They have strong profit margins, with their fiscal year 22 expected to have an estimate of 15% profit margins. They are also expanding their Nike factory stores and going more direct to consumer, like I stated earlier. And they have high growth potential in China and other emerging markets, as they become as they already are the leading brand in North America. They're looking to solidify their footing outside of North America. Before I go ahead and pull this up, they also were able to bring in record revenue. Sorry, I want to go ahead and pull this up. They were able to bring up record revenues. So if I pull up the income statements for the year and change this to annual, you can see for 2021, they brought in $44.5 billion worth of revenue. That is a crazy amount. And that's after rebounding from 2020, where they ended the year at 37.4. Their total operating expense for that year was 37.6 or 37.7, and then their gross margin ended up being around 6.9 million, or a billion, I'm sorry. As we look at their quarters, you can see that their revenues, while they did take a slight hit there, and as well as their OI taking a slight hit, they're still doing remarkably well within their industry. If we go ahead and look at their earnings, they typically bring in strong earnings. With the last time they missed earnings was in the period ending in 2020. Of course, that was during the recession. So yeah, this is a company that I strongly, strongly believe in. If you look at their price targets, so for their bull case is sitting at 185. Their base case is sitting at 142, and at their bear case is sitting at 106. With 15%, or with 15 analysts, or 68% of analysts saying that they will end up on that buy-in side, so close to that 185. So it is something that we do see, that if you're a bull in Nike, you can basically see what this does for them. Again, I am a big believer and buyer of Nike, and I will continue to buy as long as they continue to keep dominating within their sector. Now to round this out for tip of the week, I want to go ahead and show you guys, or talk about what a strong dollar means against the world. So if you were to go here to research and ideas, and then go to currencies. This shows you the current exchange rates of the dollar compared to euros, pound, and the yen. Now, here's what this means. A stronger dollar against other currencies means that our products are more expensive. If we're trying to be the market for the free world, we want to have, in a sense, a weaker dollar is better for trade. Why that is because if our products are less expensive to buy abroad because internationally people are coming over to buy our products, that means we're able to export more and make our market stronger. Now, if you were to look at our chart, we the talked about the euro and how they're currently that price. If you look, we hit a 5-year low at $1.03. $1.03. This is very alarming because this is showing that our dollar is strengthening. And if you were to look as the dollar has strengthened, you can see that the markets have declined as well, right? Everything is going down. So if we also go back and look at if we look at the Australian dollar or the Aussie dollar compared against the dollar, you can see that also sliding down as well. There being 69 cents to the dollar. If we were to look at the pound as well, this is sitting at 122. I believe. Is this so low? No, we got to as low as a dollar and 14 cents. Now it's back in the pandemic, but we're slowly sliding down as well. Um, but again, we don't have a weak dollar, but we want to have a weaker dollar to help grow not only businesses or to make our products seem more attractive. Um, this is something that I am currently watching, only for the simple fact of if we can get our markets and everything under control, as the dollar starts to retreat, you'll start to see our market basically try to go back up and fight that as well. But this is something that I am watching, and something that you guys should be watching as well. Um, these are indicators that I watch to see whether we have a strong or weak market and to kind of see if there's any hiccups coming down the road. So I want to be able to see this stable out and catch its footing and rise back up. So that's the tip of the week. I want to go ahead and show you guys that. And again, I do apologize for having a 3-week layoff. We had some good news within the family that I'm not going to share. I'm going to keep that private. But I want to go ahead and get this out to you guys and continue to give you guys good and strong information that I believe you guys will need for your trading journey. So I appreciate y'all. I'll be back next week, and hopefully it won't be another long layoff. So thank you guys.